Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Booyah, progress has been made. Okay, so we talked about periodic method for valuing inventory. Let's now talk about the perpetual method of valuing inventory. All right, so unlike the periodic method, we're going to do this perpetually. So let's first define the word perpetual. So this just means occurring repeatedly. So tying this back to accounting for inventory under the perpetual method. Here we're saying that inventory is going to be accounted for and valued repeatedly on an ongoing basis. And that is going to be done after each purchase and after each sale. So what that means is we're going to be recording the inventory transactions in a journal entry after each transaction takes place. So if Boobaloo purchases inventory on 3 separate dates in January, basically what that tells us is that we're going to be recording inventory after each of these 3 purchases. Okay, so we're going to have a debit to inventory for the incoming inventory that's been purchased, and a credit to either cash or accounts payable, depending on whether or not we paid for this on credit. Okay, and again, we're going to be doing this perpetually. So not only are we going to be recording this after each purchase, but we're also going to be making a journal entry for each sale of that inventory. Okay, so we're going to have a debit to cash or accounts receivable when it is subsequently sold, and we're going to have a credit to the sale, okay, so to revenue. And as we mentioned previously, we're always going to associate the sale of inventory to cost of goods sold. So we also need to record the debit to cost of goods sold and a credit to the associated inventory that has been sold and is coming off our books. Okay, so this is ultimately a much more exact way of valuing inventory, and it's a method that would make more sense if we had a lower volume of inventory transactions. Okay, so if Boobaloo wanted to have a more exact value of their inventory, then perhaps they would do this in a perpetual manner, as opposed to a one-time count at the end of the period. Okay, so this has been known to be a little bit more of a challenging way to value ending inventory and cost of goods sold. Okay, so we're going to go through a couple of examples related to the perpetual method for valuing ending inventory and cost of goods sold. All right, but what I want you to keep in mind is that in the event that you see a perpetual inventory type question, and we're talking about perpetual FIFO, what you should remember is that ending inventory and cost of goods sold will always result in the same amount had we used the periodic method. Okay, so reverting back to our mental map, step 4. Both periodic FIFO and perpetual FIFO will always result in the same amounts. Okay, perpetual FIFO. If I'm seeing perpetual FIFO, I am salivating at the mouth at the Prometric Center. And the reason is because what this tells me is if I see a perpetual FIFO, I could technically apply the periodic method and get the same cost of goods sold and ending inventory value as had I applied the perpetual method. All right, but we still need to know the perpetual method and get some repetition in because this is still a method that we need to understand and it's ultimately going to get tested. Okay, so when you think about perpetual, the perpetual method for valuing inventory is going to be valuing this on an ongoing basis. So we're going to think of this as red light, green light. Okay, so we're going to be starting and we're going to be stopping as sales have been made. So focusing on when the sale took place. Now, reading through this same example, we're going to focus on when the units have been sold. Remember, when applying the periodic method, we were disregarding the 2,000 units that had been sold after the first purchase and the other 2,000 units that were sold after the second purchase. But now that we're applying the perpetual method, we need to focus on when the units were in fact sold. Okay, so we have the same cost of goods available for sale amount. Right, we still have 3,000 units purchased at $3.25, 2,500 units purchased at $3, and 4,000 units purchased at $3.50. So cost of goods available for sale will still be $31,250. So we know that the first 3,000 units were purchased at $3.25, And we know that the first 2,000 units were sold after the first purchase. So we need to stop right there. And we remember that this is perpetual FIFO. So our starting point is going to be from the beginning when valuing inventory and cost of goods sold. Okay, so as of this sales date, we need to start from the first units that came in. Okay, so now that we're stopping and we're working backwards, we are focusing on obviously the 3,000 units, right? Those are the first units that came in. So the first cost of goods sold calculation will be 2,000 units, right? The 2,000 that were sold after the first purchase at $325, which is going to give us $6,500. Now, starting up again, we know that we purchased another 2,500 units. Okay, but wait a minute. We sold another 2,000 after the second purchase. So working backwards again. And remember, again, this is perpetual FIFO. So this tells us that we're starting all the way back from the first units that came in. So of the 3,000 units from the first purchase, 1,000 units remain after the first 2,000 units were considered. Okay, so from purchase 1, 1,000 units that remain will be multiplied by the remaining 325 cost. That gives us 3,250. Okay, so 3,250 is the remaining cost of goods sold from this 1,000 units. So we still have another 1,000 units that remain. So now we're going to the second most recent units that were purchased. So that represents the 2,500 units. And we see that the 2,500 units were purchased at $3. So we're recording cost of goods sold for the remaining 1,000 units that were sold from this 2,500 unit cost per unit amount. All right, so 1,000 will be multiplied by $3 per unit. That gives us another cost of goods sold of $3,000. All right, we've now exhausted all 4,000 units that have been sold. Okay, so we could calculate our ending inventory. So from purchase 1, no units remain, so there's no ending inventory. From purchase 2, 1,500 units remain, right? We sold 1,000 of the 2,500. That's what's coming off the books. So 1,500 will still be valued at the $3 per unit, which gives us an ending inventory balance of 4,500. And the entire 4,000 units purchased from purchase 3 will be considered ending inventory, right? None of this was sold. So 4,000 units would be recorded as ending inventory at $350. All right, so the entire 14,000. That gives us an ending inventory balance of $18,500. How do we check that? We take cost of goods available for sale, $31,250. We reduce it by the cost of goods sold of $12,750. That gives us our check for $18,500. All right, but well, what do we know? Cost of goods sold for perpetual FIFO and ending inventory for perpetual FIFO are the same numbers that we use to calculate cost of goods sold and ending inventory under periodic FIFO. All right, so that's all I'm trying to say is that this is not going to change. So technically you could use the periodic method for determining this on the exam. Okay, perpetual LIFO. This is actually where it does matter that we apply the perpetual method. It's only perpetual FIFO that will calculate cost of goods sold and ending inventory as the same amount that we would have calculated under the periodic method. Okay, but perpetual FIFO will result in different amounts. Okay, so again, whenever we're focused on the perpetual method, we need to determine when the units were actually sold. Okay, so again, we know that 2,000 units were sold after the first purchase, and another 2,000 units were sold after the second purchase. And again, now we're starting with the last units in being the first units out the door. In other words, the most recent units that are coming in will be the first units that are going to be accounted for as cost of goods sold. All right, so again, first 2,000 units were sold after the first purchase. Okay, so again, we're playing a game of start and stop, right? Red light, green light. So obviously starting at the 3,000 units purchased from purchase 1, after we stop to account for this when we made that 2,000 unit sale after the first purchase, right? These are the only units that are currently on our shelves as of this sales date. So we're going backwards from this sales date, all right? So 2,000 units will be recorded at $325. Okay, so $6,500 is our cost of goods sold from the first 2,000 units sold. Okay, so now moving on into the second 2,000 units that were sold. they were sold after the second purchase. Okay, so after this first 2,000 unit sales date, we purchased another 2,500 units. So we started again, and now we're stopping again. All right, so only now we're stopping and applying the last in, first out method. So we're going to be starting from the most recent units that were purchased. So we're starting at 2,500. So we're going to be pulling these 2,000 units that were sold from this 2,500 unit batch, and we're going to be accounting for them at this cost per unit. All right, so 2,000 units are going to be accounted for at $3 per unit. So cost of goods sold from the second 2,000 units that were sold will be $6,000. Now we can determine our cost of goods sold amount. Right? We know that we have that same cost of goods available for sale, nothing's changed. So we have $31,250, and we have cost of goods sold of $12,500. So thinking about ending inventory, from the first units that were purchased, 1,000 still remains. Okay, so of the 9,750 available for sale, only 6,500 was sold. So we have ending inventory of 3,250. Now, in the second units that were purchased, 500 still remain, right? We sold 2,000 from the 2,500. So 500 multiplied by the $3 per unit gives us $1,500 remaining in ending inventory from the second units purchased. Now we have purchase 3 of 4,000 units. So those are going to be accounted for at the total 350, right? None of these units were sold. So 4,000 at 350 gives us 14,000 available for sale. None of them were sold. So that entire 14,000 will be reported as ending inventory. We can now determine our ending inventory balance by adding these three up. That's going to give us 18,750. All right, so we could take our total cost of goods available for sale, we could back out our cost of goods sold, and this should all check out. All right, but at the end of the day, although these numbers are sort of similar to what we calculated under periodic LIFO, they are different. All right, so we need to apply this perpetual system for determining cost of goods sold and ending inventory if we get a perpetual LIFO example. Okay, so remember, this is a game of start and stop. And when we're thinking about FIFO, we're starting with the first units that came in, right? The oldest units that are sitting on our shelves. And when we're thinking about LIFO, we're thinking about the most recent units that came in, right? The last in. So this is going to be the most recently purchased units sitting on our shelves. Those are the units that are first going out the door.